A very good morning. Welcome to our Kickstarter discussion, where we shall be, delving into what is happening in the corridors of power and the government's continued effort to ensure that it gets enough money to be able to finance most of the programs that it intends to roll out for the Ugandans. On that backdrop, allow me say that we need to understand the government's concessional loan bid. Of course, a meeting that was held on Monday was to discuss up to 9.5 trillion Uganda shillings, money needed by the government for development and infrastructure financing. With me is Mr. Ausi Kibowa, an economist at ISER, who is going to help us wade through these very troubled economic waters. A very warm welcome, Mr. Kibowa.
Thank you.
Do I get that right?
Kibowa.
Kibowa.
Yeah, without an M.
My apologies for that.
Sure.
Good.
Good
First,
morning to you.
Good morning.
Good morning to all our viewers.
You're most
I'm
welcome.
really happy to be here.
Thank you for making time. Before we get to the nitty-gritty of discussing this particular concessional loan, and hope to be joined a little bit later by the MP for Maracha County, Dennis Lee Oguzu, who will be giving us a bit of perspective from a legislator's view, since they've been required as the Committee of the National Economy to be able to quickly ensure that this particular loan is passed. First, bring us up to speed with what this latest bid by government is and what it means for our ability to sustain the kind of debt.
Okay.
Yeah.
So this loan is from the government is borrowing 455 million euros from the commercial markets externally.
Yeah.
So normally our government borrows domestically from private lenders, that is our own banks here, and also from institutions like the IMF and the World Bank, but also bilaterally with countries like France, Germany, US, and the likes. But what we are seeing with this loan is now the government is moving a step further to now go to commercial lenders who are external. So this money is going to be borrowed in a foreign currency from Standard Chartered Bank. 455 million euros.
That's around 9.5 trillion Uganda shillings?
That is, I think when you do the calculations, it's around 1.7 trillion Ugandan shillings. Yes.
Wow.
So
that's a staggering sum of money.
Yeah, that is a staggering sum of money. We are worried. Yeah. Government seems to be swimming towards the deeper end of the ocean. We're not sure whether they will sustain this when the tide comes. And the tide is coming. The tide is coming.
ISER buries itself in understanding the dynamics as far as the economy is concerned, and of recent your voices have been very amplified on debt sustainability and the direction that the country is taking. And when you speak of the fact that we might not be able to make it in light of this particular swim towards the deep end, it speaks of a grim reality, no doubt about that. But within the current crisis that the nation finds itself, what are the options? If we are, for example, say, perhaps this is the least or last option the government should be considering, what other options are there for government to be able to quickly galvanize funds and be able to carry on its duty?
Yeah. So maybe I'll first talk of why this loan in particular might be worrisome.
Okay.
And then I could give what options we might have.
Perfect.
So this is a non-concessional loan. A non-concessional loan means a loan that isn't on the best terms out there. What is happening is that this loan we are taking is subject to variable interest rates. So this is a loan we are taking from, like I said earlier, from in euros, that is a foreign currency. Yeah. And the interest rate for this loan is pegged onto the euro interbank rate. So this is the rate at which banks within the eurozone lend
to each other.
Yeah. And why this is worrisome and why I would say a tide is coming. There has been a lot of news that there is a lot of global tightening going on right now. What tightening means is that the Fed, the US Federal Reserve, which is the bank, the central bank of the US, but also the European Central Bank for the European Union, are raising interest rates to fight inflation. What this means is that all loans that have been acquired within their currency are subject to this volatility. So as interest rates by the European Central Bank go up, all the loans that have been contracted within that currency are subject to moving up. What that means is that we could see over some time the costs of repaying this loan go up in no time. So this loan, we'll start to repay this loan in about 4 years from now. That is in 2026. Yeah, the IMF has projected that the current crisis could go on up to around 2025. So we'll just be coming out of the crisis, and we'll have to start paying our loan. Yeah, in an environment where the interest rates have already gone up. So the costs of repaying this loan will actually have already risen. What does that mean? It means that resources will then be diverted from meeting other critical needs of the country, and these will then go towards paying off this loan. So in just 2026 is really not far from now. Here, we'll have to start diverting our reserves within the central bank towards paying this loan. This can have serious implications. I'll give you an example. We all saw what happened in Sri Lanka recently.
The total collapse of the economy.
Yeah. Much of that collapse was linked to the loans that the government had accrued over time. As the government went on paying those loans, the external loans, these loans then sucked out the reserves from the central bank. Moreover, mind you, these countries do import using foreign currency. So if you use the available foreign currency to pay off your loans, that means you won't have money to import your critical items. And that is why we saw Sri Lanka get into a fuel crisis. It's not that fuel was out of the market. No, they no longer had the foreign currency
to be able to get
import the fuel they needed. But all this stemmed from that debt, the commercial debt that they had accrued over that time period, and that created an obligation on their governments to service these loans. So the economy collapsed, people are struggling, the prices of everything actually then went up, and the government had to exit.
Yeah, it's a very grim assessment there, and of course when you juxtapose Uganda's situation to Sri Lanka, it kind of comes home, somebody understands what exactly is going on, but in light of the fact that there must be something that can be done within any particular crisis any country finds itself in, and the options are always there. Concessional, non-concessional, what kind of currency you guys are going for when getting some of these loans. There were some insiders who were concerned that this particular concessional loan ought to have been gotten in dollars, but it's going to be in euros in light of what you talked about, the interbank, the Eurobor and Libor. Just take us through the dynamics. If we are to get in this loan in the euros, ideally the euro is greater than the dollar, but because the dollar is what is widely used at the end of the day across the globe, there's a tendency to think it is, you know, greater in terms of worth. What are the dynamics? Personally, I would struggle to come to terms with it. Now imagine my other person in Butaleja.
So the argument by the finance ministry for why they actually chose to go for this loan in euros as compared to getting it in dollars. Yeah. And actually the reason why they then had to go to the euro market to get this loan was because the level of interest rates that were being charged in the Eurozone was much lower than by the time they went to negotiate this loan. Yeah. Was much lower than compared to the loan, the interest rates within the US. Yeah. So by the time government started negotiating this loan, actually interest rates were negative in the Eurozone. So the euro interbank rate was negative 0.45, which was a good rate back then. But then, because of the current tightening, in just a span of 7 months, the interest rate more than quadrupled. It moved from negative 0.45 to now 2.2%. Yeah, that is how risky it is taking on a loan that is on non-concessional terms, and most especially from in a currency that you do not have control over. So the interest rates went up that fast, and what we are worried of, and why I say that a tide is still coming, a huge tide, and we are worried whether the government will actually sustain this tide, is because the ECB, the European Central Bank, is still tightening, so it is still rising interest rates. Yeah. So if they are right now at 2.2%, there is a chance they can even get to something like 7 or 10%. So if our loan right now, the loan was acquired at an interest of 3%, it can go to something like 10, 15%. That means the costs of paying back that loan can go up substantially and cause financial instability within the country. When the pandemic came, we saw several developing countries get into a financial crisis. I've already mentioned.
That's right.
Sri Lanka, there is Zambia, there is Chad, Ethiopia, even our neighbor Kenya. The reason many of these countries were getting into a financial crisis was because of this kind of loan, the commercial external loan that they had acquired. So interest rates were going up and they could no longer sustain paying back this loan. And what the challenge with this is that when this happens, countries have no option but to then borrow again. So they then go to another bank, maybe you might say this time Barclays, to borrow to pay off the maturing loan. So there is a chance that in 2026, when the time comes for us to pay off our loan, we could end up having to borrow again to pay off this maturing loan. And that creates
an unsustainable cycle.
Yeah, and that creates a certain cycle, and that gets us captive to this foreign capital, to the influence of foreign capital. Yeah. The other challenge with these kinds of loans that are commercial and external is that these lenders do not provide debt restructuring or relief. Debt restructuring is a situation where I borrow from you money and then I get into a shock. Maybe I lose my job, I come to you and I negotiate
new terms
for relief. Yeah, hey, maybe could you suspend my repayment period for this loan? Now, commercial lenders like Standard Chartered Bank actually do not want to engage in those kinds of conversations. Yeah. The other lenders who normally are open to having these conversations are the IMF, the World Bank.
Those are institutional lenders.
Yeah, but also bilateral lenders like China. China actually offers debt relief to countries in times of crisis. But commercial lenders, I haven't heard of any instance where a country got into a crisis and they wanted to restructure their loans and commercial lenders were willing to do that. It only happened for Ukraine. It only happened for Ukraine.
Because it was a special circumstances.
It was a very special circumstance, and they very well knew that even if they did not allow for restructuring of Ukraine's loans, Ukraine was still just going to default.
That's right.
Yeah, so Ukraine wasn't going to pay them any money. So they had no option but to rather allow, because when you restructure my loan, when you allow me some more time to get the money to repay you, that means there is still a chance that I'll pay you back your money after the restructured period. But if you refuse to restructure my loan, I then have two options. I either keep paying the loan or I default.
Okay.
Yeah. So they only provided restructuring for Ukraine because they were very well aware that Ukraine at that moment was either getting a restructuring or it would end up defaulting. It wasn't going to pay its
okay. There is something that is confusing, especially for those that are not initiated in matters economics. A Standard Chartered Bank, the bank that is going to be providing this particular concessional loan, is it a proxy for Standard Chartered Bank in the UK or in Europe? Because this is a diversion away from local borrowing, and we know that since a Standard Chartered Bank is domiciled here as an independent local bank, it has the potential to actually provide these funds, but within this particular framework it's not acting as a local player.
Yeah, so we did not approach our own Standard Chartered Bank here. No. This is an external loan. We went straight. What happened was that the government put out a call, for bids, and then it was an international call. So it's Standard Chartered UK that is actually giving us the loan.
Doesn't that
not in any way connected to our own Standard Chartered?
That's interesting. But anyway, very clear right now. It's time now, let's take a break, and we shall be returning with this conversation, wrap it up to help us understand exactly what is at stake as government seeks this particular concessional loan in a bid to ensure that the 2022-2023 budget is met, especially on the prism of infrastructure and development funding. Stay with us.
At NTV.
Yes, we're glad you're still with us here on Morning at NTV. You are, of course, watching the Kickstarter segment of our program, and we are understanding the government concessional loan bid, the dynamics at play within the corridors of power. We are speaking to Ausi, Kibowa, economist at ISER, one of the organizations that have buried themselves in understanding how the economy works, but most importantly, how the government is tackling the issues of the day. We went into the break trying to understand the dynamics at play with regard to this particular concessional loan. Allow me ask you, when is the last time we were in this kind of situation where we sought money from, or rather money by undertaking an option that is not usually the first option to think about?
Yeah, so this must have happened in around 2019.
2019.
And that brought the tune of our non-concessional external loans to 1.4 trillion. So that brought the amount of loans that we accrue to such banks, to 1.4 trillion. And now government is planning to get a new loan of 1.7 trillion, which essentially will be doubling the share of these kinds of loans from external private banks. Yeah, and these loans are very, very problematic. At least even the IMF shares the same position with us. So the IMF last year, while giving money to our government, stressed that it is important that our government stays away from these kinds of loans, from loans that are acquired from private banks externally, because they really push countries into financial crisis, and actually advise that we should look into other concessional. Concessional means cheaper loans. Yeah.
The ones that are availed by the broking institutions.
Yeah, the ones that are provided by IMF, World Bank, the ones that are provided by China, US, France, by governments. Yeah. Yeah, they felt that is a much safer option, because that came from the fact, like I had already stated, that many countries were getting into financial crisis because of these particular kinds of loans. One other thing that I find very frustrating about the way this loan has been acquired is that the parliament was given only 3 days to assess the loan and make a decision as to whether they will approve it or not.
Yeah.
Which then begs the question, at what point will public consultation happen? So, Parliament got this proposal from the Minister of Finance on Friday, and today they are expected to table their report on the floor of Parliament regarding whether they feel this is a good loan or not. This is a very, very short time frame. So I haven't seen any public consultations happen.
Are you suggesting public consultations in Uganda would alter significantly the direction of such actions by the government?
Exactly, exactly. Imagine if we had a chance to go and talk to Parliament, have a discussion with members sitting on the National Committee of the National
In
Economy.
a parliament that has majority NRM, do you really expect that to be significant enough in altering?
Well, if any decisions are made in contrary to what might be better, at least they would make those decisions well knowing the repercussions. It's like what happened with Kibowa Hospital. I'm sure they really made that approval well knowing the repercussions that it will have. We are the ones in 2026 to whom the government is going to come collecting money to repay that loan. But we have had no say about the loan at any one point.
Unfortunately, we are unable to host Dennis Lee Oguzu, the MP for Mareta County, who we expected to help us understand a lot more of the detail of this particular loan. We do hope that information can be availed in our subsequent broadcasts, including the bulletins that shall be coming up a little bit later. But on the very last note, development and infrastructure financing in Uganda seems to be a bit problematic. The sheer size of money that goes into infrastructure budgeting and development is enormous. Perhaps, is there a need to look at how we use it, first of all, very quickly?
Of course, it is important that government looks into how we use this money. Yeah, because that can have repercussions on the country's finances. Yeah, and part of this could involve the fact that infrastructure is taking up a huge portion of the budget. Brings in the need for us to be very critical when prioritizing the different infrastructure projects. Which ones should actually get the money and which ones
can wait?
Which ones can wait? I'll give an example. Kibowa Hospital is an infrastructure project. Yeah, we are going to spend, in just 2 years, we've spent a third of the size of the loan we're acquiring right now on Kibowa Hospital. So we spent $175 million on the hospital, and yet this is money that would have funded our current infrastructure needs for us to save us from going to the external markets. Yeah.
Okay, Ausi Kibowa, many thanks. Economist from ISER, giving us insight and perspective on latest government effort to ensure that money is sought to finance development and infrastructure projects in the country. Like I said earlier, apologies, Honorable Dennis Lee Oguzu was unable to make it for the show. That would have emboldened us and of course given us a lot more information regarding this particular development. Nonetheless, we can be rest assured that our reporters will be at hand later in the bulletins to give us perspective and reports on exactly what is happening, especially in the corridors of power in Parliament. That's it for this edition of Morning at NTV. It's been a pleasure having your company as always. On behalf of my colleague Priscilla, Regina Naloga, and of course the guys behind the scenes that ensure this comes to you on time, many thanks. Have yourselves a lovely day.